You've saved for years. You've cut expenses, skipped vacations, made sacrifices. Finally, you're ready to buy a home. You sit across from your lender, and just as you're imagining picking paint colors for the living room, they say something that brings it all to a screeching halt. You'll need mortgage insurance. Mortgage insurance? Another cost? Another monthly fee? It's one of those financial terms that sounds complicated, unnecessary, and, frankly, a little shady. But the truth is, mortgage insurance is extremely common. And if you're not careful, it could cost you thousands of dollars over the life of your loan. Welcome to Finance Flow. Today we're breaking down everything you need to know about mortgage insurance, what it is, how it works in the US, Canada, and the UK, and most importantly, how you can avoid paying it. Whether you're a first-time buyer or just trying to be smarter with your next mortgage, stick around. This could save you serious money. Let's start with the basics. Mortgage insurance isn't insurance for you. It's insurance for your lender. It protects them in case you stop making payments on your loan. When a lender loans you hundreds of thousands of dollars to buy a home, they want to make sure they'll get that money back. If you only put down a small deposit, you're considered a higher risk. So the lender asks for mortgage insurance to reduce that risk. In the US, this is typically called PMI, or private mortgage insurance. It's usually required when your down payment is less than 20% of the home's value. So for a $400,000 home, if you can't put down $80,000, PMI kicks in. In Canada, mortgage insurance is required by law if your down payment is less than 20%. It's provided by government-backed insurers like the Canada Mortgage and Housing Corporation, or CMHC. It's non-negotiable. Unless you have that 20%, you're paying the premium. In the UK, it's a bit different. You might hear it called a mortgage indemnity guarantee, or MIG. Some lenders require it when you borrow more than 90% of the property's value. Again, it protects the lender, not you. Now, let's talk about the cost, because this isn't a small expense, and it adds up fast. In the US, PMI typically costs between 0.3 and 1.5% of the original loan amount per year. On a $350,000 mortgage, that could mean an extra $1,000 to $5,000 per year, or roughly $80 to over $400 per month, just for insurance you don't even benefit from. In Canada, the premium is a one-time fee, but it's big. It ranges from 2.8 to 4% of your loan amount. Let's say you put 10% down on a $500,000 home. You'll pay an insurance premium of about $13,500, which gets added to your mortgage and earns interest over time. So even though you only pay it once, it still increases your monthly mortgage payment. In the UK, MIG costs can vary, but they're usually a one-time fee, around 1 to 2% of the loan, and are typically required only for high-risk borrowers. So why does mortgage insurance even exist? Why are we paying money to protect someone else? It all comes down to risk. Mortgage insurance exists to help more people buy homes. Without it, lenders would likely require massive down payments, locking out first-time buyers or anyone without access to a large amount of savings. So, in theory, mortgage insurance creates more opportunities. It allows buyers to get into homes sooner, even if they haven't saved 20%. But while it opens the door, it also adds weight to your financial burden. And that's why we're here, to talk about how to avoid it. The most obvious way is to save up and put down 20%. It's the gold standard. If you can put 20% down, you eliminate the need for mortgage insurance in almost every situation. But for many people, especially in expensive cities, 20% can feel impossible. That's where strategy comes in. In the US, one workaround is the piggyback loan, also known as an October 10th 80 loan. Here's how it works. Instead of taking out one mortgage for 90% of the home's price, You take out two loans. One covers 80%, the second covers 10%, and you bring the final 10% as a down payment. This keeps your main mortgage under the 80% mark, so PMI isn't required. But keep in mind, that second loan often has a higher interest rate and can come with extra fees. Another U.S. strategy is lender-paid mortgage insurance, or LPMI. Instead of charging you monthly PMI, your lender pays it up front, but increases your interest rate slightly. This can lower your monthly payments, but you'll pay more in interest over the life of the loan. If you plan to sell or refinance in a few years, it might make sense, but if you're staying long-term, it could cost you more. In Canada, your options are more limited. If your down payment is less than 20%, mortgage insurance is mandatory. But you can minimize the cost. For example, if you put down 10% instead of the bare minimum 5%, your insurance rate drops from 4% to about 3.1%. That's a few $1,000s in savings right there. You can also look into shared equity programs in some provinces, where government or non-profit partners help you boost your down payment in exchange for a share of future appreciation. In the UK, avoiding MIGs largely comes down to keeping your loan-to-value ratio below 90%. That means a 10% deposit or more. Some lenders will waive the indemnity guarantee if you have strong credit, so it's worth shopping around. Regardless of where you live, one of the smartest strategies is to refinance your mortgage once you reach 20% equity. In the US, you can request PMI cancellation at 20% equity, and it's often automatically canceled at 22%. In Canada, you can't remove mortgage insurance from a loan once it's added, but refinancing into a new uninsured mortgage later is possible once your equity grows. Another tip: choose a cheaper home, at least for your first purchase. It's easier to save up 20% on a $300,000 home than on a $600,000 one. That lower price can mean the difference between paying and avoiding mortgage insurance altogether. Let's recap. Mortgage insurance protects your lender, not you. It's typically required when your down payment is under 20%. It can cost hundreds or even thousands per year, depending on your country, lender, and loan size. To avoid it, save up for a 20% down payment, consider piggyback loans or lender-paid options. Refinance once you have enough equity, or buy a less expensive home to start. In Canada, minimizing insurance premiums through a larger down payment can still save you big over time. In the UK, choosing lenders carefully and keeping your loan-to-value ratio under 90% can help you dodge extra fees. The takeaway is this: know the rules before you sign the dotted line. Mortgage insurance isn't evil, but it is expensive. And if you're informed, you can make smarter choices that keep your money where it belongs, with you. If this helped clear up the mystery of mortgage insurance, give this video a like and share it with someone who's house hunting. Got questions, tips, or stories from your own home buying journey? Drop them in the comments. We'd love to hear them. And don't forget to subscribe to Finance Flow for more clear, practical personal finance content made just for you.